I-16, Property, Plant and Equipment, Exchange Transactions. This is a summary of the main content of I-16. Accounting treatment comprises recognition, measurement, and disclosure. This presentation focuses on measurement and specifically initial measurement where a PPE item was acquired in terms of an exchange transaction. Paragraph 24. One or more items of PPE may be acquired in exchange for a non-monetary asset or assets, or a combination of monetary and non-monetary assets. The following discussion refers simply to an exchange of one non-monetary asset for another, but it also applies to all exchanges described in this preceding sentence. What is the issue at hand? You now receive or acquire a PPE item in exchange for another asset. So you get PPE, but you give away one of your other assets like inventories or another PPE item. We now need to determine the cost price of that item acquired. The paragraph says, the cost of such an item of property, plant and equipment is measured at fair value. That's the first rule. Unless, some exceptions, the exchange transaction lacks commercial substance or the fair value of neither of the asset received nor the asset given up is reliably measurable. The acquired item is measured in this way even if an entity cannot immediately de-recognize the asset given up. If the acquired item is not measured at fair value, its cost is measured at the carrying amount of the asset given up. Let's summarize that. The normal rule is all PPE items is initially measured at cost. Paragraph 24 gives us very specific guidance where an exchange transaction is involved. All exchange transactions, the item that you receive, that you've acquired, the new PPE, is measured at fair value of the consideration given. That's first price. When will you not use fair value? Two instances. Either where the transaction lacks economic substance or where you cannot determine fair value. Let's look at when does a transaction lacks economic substance. If the two items that you are exchanging is exactly the same and the entity is in no different situation before the transaction compared to after the transaction, there's no change in future economic benefits, then the transaction lacks economic substance and nothing will be recorded. What are you now going to do if you do not have fair value available of either item? Then you'll determine the cost price of the item received as the carrying amount of the asset given up, because that you should be able to determine. So what is my order? First price. The cost of the PPE acquired is the fair value of the asset given up. If I do not have that fair value, I measure it at the fair value of the asset received. If I cannot determine either fair value, the cost of the new PPE item is the carrying amount of the asset given up. Let's look at an example. I have a forklift truck that is exchanged for a computer. So I'm giving away the forklift truck and I'm receiving a computer. On the date of the exchange, the forklift has a carrying amount of 20,000 Rand, which consists of a cost price of 60 and accumulated depreciation of 40. The fair value of the forklift truck is, however, 15,000. In addition to giving up the forklift, the entity also paid cash of 3,000. This transaction has commercial substance. So what is the issue at hand? I'm getting a computer, I'm giving away a forklift, and I'm giving away 3,000 Rand cash. I need to determine the cost price of the computer. What does paragraph 26 say? It's the fair value of the asset given up as a first price, the 15,000, There we go. What am I also giving up? Cash of 3,000. So I must not forget about the cash given up. And that added up gives me the total amount of 18,000 as the cost price of the computer. The journal entries, first of all, you have to de-recognize the forklift that you're giving away. That involves a debit of accumulated depreciation of 40, credit against cost of 60. Then I recognize the new asset, the computer's cost, at 18,000, which we've just calculated. Very important. Don't forget about this 3,000 amount. You've given away some of your cash, so you have to credit your bank with the 3,000. And then you end up with a balancing entry, loss on exchange transaction. Profit or loss, 5,000.